Good evening, everybody. It is Steve with Real Progressives. For the many people out there who gave me a hard time about having the sky rise here, I went low rise in honor of my guest tonight, who is absolutely a gentleman and scholar. And because of that, I felt the need to go with a dapper look here. But in any event, we're going to talk about a subject that I haven't really done a whole lot with. Largely because I'm just starting to learn about it myself. And, I try not to go too far afield from areas that I feel confident in, but I like going there with people who I trust. And I have Rohan Gray with me tonight. You all have seen Rohan join us before. He is a master of Federal Reserve history. He's a master of all things that I'm not. In other words, all the nuanced details that go beneath the surface. That's what I love about bringing Rohan to the show. So without further ado, Rohan, welcome to Real Progressive, sir.
Thanks for having me, Steve.
So, I noticed that your beard has gained a little bit. I mean, my beard I was feeling was pretty long, but I'm looking at yours and I'm going, wow, man, I'm slow in the beard game here.
Yeah. I'm still late to come out of winter. I'm emerging from hibernation slowly, but it'll get sort of smoother soon. But.
All right, so you guys are part of something really wonderful. It looks like going on in September at UMKC. It's a great conference. I believe it's a 3-day conference. You want to talk a little bit about that before we jump into our subject?
Yeah, sure. I mean, it's at the University of Missouri, Kansas City. It's specifically on modern monetary theory. It's going to have a lot of the big names: Stephanie Kelton, Bill Mitchell, Randy Ray, Warren Mosler, all going to be there, among others. Pavlina Chernova, Scott Philweiler, Matthew Forstater, Eric Timor, and I'm sure I'm missing other names. But I think it'll be a very kind of historic event in this intellectual history, which I think, even people who have some cursory interaction with this body of, literature and knowledge sees that the intellectual history is intimately intertwined with the ideas, who these people are, who they were, what roles they played in society when they had these arguments. It really matters. So it's a big deal for all these people to come together and to have a shared space and a shared experience. And I think people who are interested in these ideas should feel welcome to come and attend and to be a part of that moment in history, because I think when they write the history of this era and of the responses to the crisis and to the rise of right-wing fascism and austerity economics and the crisis in the Eurozone and the banking crisis, I think these names and these ideas will play an increasingly important role. And it's one of the beautiful things about the people who put forward these ideas is from the start it's been an open door for people who want to get involved and to help spread these ideas. So I think people should feel welcome to attend, and I think it'll be a really important moment in the development of these ideas in broader society and in the mainstream of opinion.
So I want to ask you something very, very high level before we also jump in, and that's regarding, obviously I'm not party aligned with anyone at all. We are progressive, so we have a ideological bend, if you will, but it does not inform my economics. My economics informs my ideology, so to speak, and they work in tandem. But quite frankly, the kinds of economics that you talk about and we discuss here are agnostic politically. They're not intended to be seen as this or that. It's just a description of the way currency actually operates, correct?
Well, I mean, yeah, there's two parts, I would say, or they're sort of connected. I mean, one is understanding how the system operates, and then it's understanding the potentials of that system, and not just the potentials, the actual current outcomes as a result of deliberate decisions. So once you understand how the system works, it becomes clear that certain aspects of the way the world works, for example, involuntary unemployment, is a deliberate feature of the design of our economy. It's not a result of individuals not working hard enough. It's not a result of robots or changing technological structures in the in the production system. It's not a result of different skills mismatches in the labor market. It's a deliberate result of the economic design. So once you understand that, it becomes very clear that if you want to deal with that problem, there are ways to do that. Now, whether you want to deal with them or not is a question of politics. It's a question of what you value. Obviously the reason why you draw attention to these aspects of the system is because you think they're relevant, and you think they're relevant to current problems. So I don't think it's political in the sense that you're starting with things that you want to be true. You're starting with things that are true. And what you're then inductively implying from that is, because this is how the thing works, we can and should change it. And so I think those two parts are connected. I don't think that they're independent of each other. I think there's a reason why we focus on one topic over another. And I'm reminded Joan Robinson wrote a great article, which Jacobin republished recently, called An Open Letter from a Keynesian to a Marxist. And one of the things that she says in there is, Adam Smith's and Ricardo sort of laid out classical political economy. They laid out all the big questions. They started dealing with all the answers. And then after them, Marshall came about and asked a different question. He said, rather than talk about all these aggregates, why don't we talk about the price of a cup of tea? And Marx turned around and said, rather than talk about that, why don't we talk about sort of how to change the sort of underlying structure? And so I think what's interesting is what you choose to focus on. And if you look at the way that macroeconomics or the media talks about the economy and talks about growth, they choose to focus on certain problems and certain metrics and certain outcomes. And by talking about how the system works and shining a spotlight on the particular things that MMT shines a spotlight on, it forces a different kind of conversation to take place. And I think that is the real value of understanding the system, is you understand that you've been focusing on the wrong place. You've been focusing on the wrong levers, the wrong pressure points, and the wrong culprits for the problem.
That was beautifully stated, Rohan. I mean, to me, when I think about what we're trying to do, I've made jokes, only mildly jokingly, about going into Republican enclaves, going out to talk to libertarians, go talk to anybody that'll listen to me. They'll give me 5 minutes to even venture into their space and talk about this, because I really believe at the root of all of this, people love their children. If you just assume that everyone loves their kids, at least at some level, you can start making some informed decisions if you're not focused on the wrong things, as you clearly pointed out. So,
yeah, I think it makes sense to start with assuming people have the right intentions, and I don't think that everybody always does, but I think it's a fair thing to start there. And I think the other thing is that, in some online communities they call it mind share, but even going back to sort of the 30s and the 40s, with propaganda, with the big lie, there's just a matter of simple repeating certain ideas for long enough ingrains them in people's heads, even if they don't think they're necessarily true. So it matters just the sheer fractional volume of how much certain ideas are talked about relative to others. And, I think about this from a global perspective because I was born and grew up in Australia. I spent time in Japan. I spent time in the UK. I spent time here. I've, traveled a fair bit. And there are different political constructions in those different countries. There are different parties in the UK, there are different parties in Australia, different parties in Europe. So yeah, I do think it's not about Democrats versus Republicans, or it's about, I only want to work with Team Blue over Team Red. I think what you want to do is move past the point where this is a debate amongst anybody. We're not still debating child slavery. We're not still debating public education. We're not still debating running water. We've moved past the point where these ideas are things that people consider to be controversial. And I think that's where we want to move understanding about money and understanding about unemployment too. We want to move it to the place where it's post-partisan. And obviously there's going to be a struggle. I'm not saying that it's some technocratic, apolitical conversation. You're going to have a political struggle to get there. But I'm saying, yes, you do take whatever possible pragmatic way to get there is viable. And I don't think you should a priori cut off avenues just because they are, not the team that you may think is the most obvious one on any day and any point in place. On the other hand, I don't think you should work with people who have horrible outcomes in mind.
Right.
I don't think if you're good at coding, you should go work for the NSA. You know what I mean? So I think in that respect, I think it matters where you put your energy and your efforts and who you work with and who you ally with. But I think you should be open to new cross coalitions of groups, and you should assume that with this knowledge, the current political constellation may change, so that people who may not have previously been potential allies may be after this information is properly disseminated.
It's funny, I almost interrupted you to try and say something akin to that, but you said it so much more elegantly. So I want to get to the crux of what we are going to talk about tonight. Obviously, folks are enamored of, I don't know why they skip past MMT and knowing how the system works, but a lot of these people seem to, oh wow, I'm going to go talk about public banks. It seems like the new shiny object, but there's some good things in there and so forth. And I think much of it is misunderstood. I think some of the benefits are coming out of fixing problems that maybe don't exist or maybe do exist. So talk to us a little bit about what the public banking craze is all about and what its merits are and where it fails.
So I think first thing I think is it's important that there are different people with different goals and strategies and sort of analyses out there that are under this broad umbrella, and not all of them should be tarred with the same brush. So I know, for example, Ellen Brown, who is the head of the Public Banking Institute. I think they do very good work. I have a lot of respect for her. I think she tries generally very hard to get things correct. I think she tries to be very direct and plain spoken with people, and not to, talk in an esoteric way. And I think she works very hard with anybody who will work to make those ideas a reality. I don't think that public banking is the be-all and end-all of progressive economic, macroeconomic, or monetary reform, which is where which is why I'm not sort of signed up working full-time for the Public Banking Institute. And that's not to say that I don't think it's important work that they're doing, but I just don't think that's the sort of where I would start or end my sort of story or way of framing the problem. Now, there are other people, unfortunately, who have a different approach and have what I would call a kind of hedgehog approach, which is to go to what Isaiah Berlin said. There are two kinds of people. There are people who know one big thing, who are hedgehogs, and there are people who know many little things, who are foxes. And a lot of people think that MMT is a hedgehog because it has one idea. But I think actually if you look under the hood, there are a lot of different ideas that work together. And the fact that MMT has insights for so many different sets of problems, not just unemployment, but also banking and fiscal policy and central banking and a whole range of things, demonstrates that it's not a one-shot gun. Whereas what you hear with a lot of the anti-private banking group is they have discovered the true fact, and I stress it is true, that when banks create loans, they generate deposits out of thin air, and those deposits, which are just liabilities of the bank, function as money. So it is true that under the current system, commercial banks create private deposits, demand deposits, which function as money. And they don't do that backed necessarily with prior reserves or prior deposits. They do that ex nihilo. That it fits in a broader story of how banking works, which I'll get to in a second. But it has problems. It is important to know that it has problems. So they've identified a real fact about how finance works, and I've identified a real problem, which is that banks have too much power in our economy and our political system. But the way they then frame that is the problem with our monetary system is that it has been privatized, and that banks have privatized the money supply, and that they have privatized the process of generating seigniorage revenue, and as a result, we have been constrained from doing things fiscally that we should be able to do. And generally, their proposal is to end the ability of banks to extend loans and create deposits, and to only make the government able to create money. That is to say, to revert everything back to a form of fiscal policy. There are some more nuanced groups that acknowledge that banks should still issue money, but want to do it in a way where they take on risk, so that if they fail, the people who were holding cash at that bank would lose that cash. They would have been considered to be taking an investment in the bank as though it was something like a mutual fund, and in the event that it went under, they would lose their money as though it was a bad investment, sort of like before there was a central bank and there used to be runs on private banks. Now, the good thing about public banking is that the point about public banking, there's a couple of points. One is that it can be a public option. It can demonstrate that certain functions which are currently performed by private banks can also be performed by entities functioning as public utilities. And they can do so at maybe similar or even better prices, similar or even better quality, and at similar or even better levels of coverage. So that's one benefit of a public banking system. Another benefit of the public banking system is that you can establish an infrastructure upon which private entities can develop secondary layers that can increase efficiency. So it can serve a kind of general infrastructure function, just like we create roads so people can drive on them, or we create, public internet hubs so that people can create web pages and things. So the third option is to, ultimately drive the private banking system out of existence, to demonstrate that it's obsolete, and to provide things that do similar functions to the current banking system, but with a different underlying agenda. For example, issuing loans to promote environmentally conscious or, renewable energy investment, as opposed to financing loans that are merely profitable. So adding some sort of triple bottom line component to the calculus that goes into investment and lending in the banking system. And I think all of those views have merit. I think they're all valid. My view is there's a lot of different things that can be changed, and it's important to think about what our goals are and what our options are. So the first thing to think about with the banking system is it essentially performs two separate but related functions. One function is as a payment system. So, when you log onto your bank account, or you log onto your app on your phone, or you want to make a payment by using a tap phone or something, or with a credit card, that's moving, typically, deposits around the banking system. That doesn't mean that, there's a sort of deposit that flies in the air or something. It means that one bank marks down its deposits and another bank marks up its deposits. It's sort of like saying, hey, you owe Jimmy a favor, now I'll owe Jimmy a favor. And in doing so, the banks then settle between each other. So what you end up having is the two people transacting with each other don't really actually transact with each other. They transact with their banks, and then their banks transact with each other. So there's a sort of two-tier system going on. It's like you have a kind of shadow, and your shadow talks to their shadow, but you don't talk to them. And it's important to understand the payment system currently operates on these two separate layers. It's very different. So you and I don't ever have access currently to the central bank. We can't go to the central bank and open up a bank account. There was a period where in the UK, if you worked at the central bank, you could have a checking account there. It was a sort of special privilege. But most of the time, you don't get your own account at the central bank. Only banks get accounts at the central bank. They're called depository institutions. Banks and credit unions and the Treasury has an account because the Fed is its fiscal agent. And so when payments happen between banks, they settle on the reserve system. It's like a special layer just for them. And when you and I send things between us, the banks just change numbers on their spreadsheets. So it's almost like Russian dolls. the banks change numbers on their spreadsheets for you and I, and the central bank changes numbers on its spreadsheet for the banks. And in the same way as the central bank has an infinity sign, the banks, in theory, have an infinity sign. They can create as many IOUs as they want to. Imagine if you're a bookie. You can create as many IOUs on your book as you want to. The only issue comes when people try to cash it in. And this is where it's really important that the banks have access to the central bank. Because imagine if you go get $1 million loan from a bank. The bank doesn't have any money at the moment. You get $1 million loan, the bank just marks up your account by $1 million. So bing, suddenly your deposit account has $1 million in it. You also owe the bank a loan. So the bank now owns your loan. It's sort of like the devil owning your soul. The bank has got your loan. Now, the bank has an IOU to you, and it has a loan from you. So from the bank's point of view, it sort of evens out. It's expanded its balance sheet, but both sides of the balance sheet are balanced. Now, if you then decide you want to take that $1 million out in cash and sort of throw it around in a big party, it needs to make sure it has $1 million of cash. So it calls up the central bank and says, can I get $1 million of cash? Now, if it has $1 million in its reserve account, the central bank just marks down its reserve account. It's like, yeah, sure, here's your cash. It's like cashing out from your account. If it doesn't have that much, it can say, well, do you want to sell me some treasury bonds? Or do you want to borrow some from me? I'll give you basically an overdraft. So the central bank will always provide as much reserves as necessary to the banks to meet the bank's needs for reserves at the target interest rate. So if the central bank wants the interest rate to be 2%, it'll say to banks, I'll lend to you as many reserves as you need at 2% interest. The banks will say, okay, well, at that much, we probably want this amount of reserves based on the amount of loans that we've made. So it's important that the interest rate is the tool by which the Fed affects lending. It doesn't control the supply of reserves. It doesn't say, today we're only going to lend $100 billion, tomorrow we're going to lend $200 billion. It doesn't do it like that. It says, we're going to lend as much as necessary at 2%. So as the MMTers would say, it's price constrained, not quantity constrained.
So let me ask you, I have two questions. Number one, it seems like the other issue that these folks talk about is the concern of the debt that we end up paying the quote-unquote central bank, and they want to eliminate that and creating...
Yeah.
So the idea that our debt is largely, I mean, it is made up of debt instruments like treasuries and so forth. Could we not, without like some crazy overhaul, just implement ZIRP or a zero interest rate policy and just eradicate this right in one fell swoop?
So the easiest way to think of this, in my opinion, is think of a bunch of different categories of government IOUs. It's sort of like some have different properties that are similar to each other, some have ones that are similar to others. In that big group, you've got coins, you've got treasury notes, which aren't really in circulation anymore. They were in circulation during the Civil War. They were called greenbacks. Lincoln issued them, and they were capped. There was basically a debt ceiling for the greenbacks of $300 million, and that's still in place today. So they can issue up to $300 million of these if they wanted to under the current law. But if you go on the Fed's website, it says these greenbacks function identically as Federal Reserve notes. That is to say, the cash in our pockets today. So it said because they're identical, there was no need to issue, 300 million of these. We just decided to stop issuing them and just issue Federal Reserve notes. So they're right. They're functionally the same. So that's another category of government IOUs, is Federal Reserve notes. The only difference is Treasury notes get booked on the Treasury's balance sheet, and Federal Reserve notes get booked on the Fed's balance sheet. That's the difference. So even though they're both government IOUs, it sort of matters which government agency you stick the bill with, just for accounting purposes, just so you can point to one over the other. That's the only real difference. It doesn't actually affect anything in terms of the sustainability or anything like that. So you've got those different kinds of physical instruments, and then on top of that, you've got an account at the central bank that the Treasury owns, which are reserves, and then you've got Treasury instruments like 3-month bills, 1-year notes, 2-year notes, 5-year notes, 10-year bonds, 30-year bonds, even like 1 or 2 week cash management bills, which they issue in very short-term notice. So all of these different instruments have, and then also the central bank can issue its own debt. It can issue its own 1-month bill or 3-month bill or 1-year, note or 5-year note or 10-year bond. The central bank can issue it just as easily as the Treasury can. It just does so. Now, most of those today are not issued in a paper form, although they used to, like a big sort of A4 sized piece of paper. They don't issue it like that anymore. They're all just book entries at the Fed. The Fed manages these accounts. They're called Treasury accounts. Or if you're an individual citizen, and this is a little sort of small pocket of difference, and I'll get back to this when we talk about public banking, you can have a personal account to hold treasuries directly with a payments operator at the Treasury Department called Treasury Direct. Now, just to clarify, this is all in the US. Every country has its own setup, and each setup is different. And that's important to note, that this is all just one choice. You could set it up entirely differently, and it could still perform all the same functions. And that's true. We know that's true because different countries have different setups, and they all run a pretty similar monetary system. So you have all these different instruments. And to go to your point, Steve, the interest rate that gets paid on those instruments is ultimately chosen by the government, by the Treasury and the Fed together. And think about it like this. If the Treasury stopped issuing any 30-year bonds, there wouldn't be a 30-year interest rate. So the fact that there is a yield curve that goes out to 30 years is because the Treasury wants one to exist. And we know this to be true because there was even a debate recently with the new Treasury Secretary Mnuchin, who was suggesting we should issue 50-year bonds. So that would have created a whole new interest rate that doesn't even exist right now. And in the UK, they have a different instrument. This is adding to that bag of instruments I was talking about, called a consol, which is a perpetual bond, which means you can never get the principal back. You just get an interest payment. It's sort of like you had a savings account, like a piggy bank, where you could put coins in, but you could never get them out again. But it would pay you interest. It would poop out interest every now and again, but you'd never get the principal back. It would just grow and grow. So the UK has those as well. So all of these different instruments, they're like different technical designs. It's like getting a car that has four doors rather than 2 doors, or that has a V8 rather than a V6, or that has an 8-seater rather than a 3-seater. It's just choosing different cosmetic layers on top of the underlying liability, and the Treasury and the Fed together create that. They choose to make those instruments work the way that they do. And to give an example of that, and I talked about this before, in 1945 to 1951, the Treasury said to the Federal Reserve, we want you to peg the long-term 30-year interest rate at 2 and I think it was an 8% or a quarter. And the Fed said, okay. They weren't really happy about it, and they fought them eventually and won eventually, but they did it, and it worked fine. So for that period, the 30-year interest rate, it wasn't set by markets, it was just fixed by the Fed. So the Fed later intentionally made a market. It's sort of like I create a weather vane so that it can swing with the wind, so that I can, feel the wind. That doesn't mean the wind is controlling me. I can set the weather vane wherever I want it to if I wanted to. I could just tighten the screws. But the fact that I let it flap in the wind is giving me information that I think is useful. That is to be as charitable as possible. That is the Federal Reserve's argument. That letting the interest rate at the 30-year long-term float allows them to sense market confidence. But that doesn't mean that it needs that market confidence to create an interest rate. It doesn't mean that if the market said, no, we're not buying anymore, that the interest rate would go through the roof. They could just stop issuing 30-year bonds and the interest rate would go away. And Warren Mosler has been very clear about this. He said particularly the Treasury should stop issuing any kinds of Treasury securities longer than 3-month bills.
No kidding. I want to ask you another question. I see a tie-in. I don't know if you will. I'm hoping you will. So obviously, one of the things that we run into as we talk about public banking and the Federal Reserve operations and so forth is the invariable, or it's a constant, the midnight blog, the 3 a.m. Infomercial, whatever. The BRICS are coming to take our life away from us. China and Russia are talking, so it's going to kill the dollar. We're all going to die. I mean, on and on and on. Folks, it's like they don't understand that there's always another lever. We move things back and forth. We do things. We facilitate trade between countries different ways. Talk to me a little bit about the death of the dollar and the whole fear mongering that goes into the coming economic collapse. As it pertains to China and Russia.
I've talked before about the fact that I think that this is all intimately tied to foreign policy power, and I don't think the US's foreign policy power is going anywhere anytime soon. But also, there are complicated supply chains between multinational corporations that go across countries and cross these trade zones. And there are complicated relationships between, interest rates and exchange rates. And these other countries might want to push certain envelopes, but they're not interested in massive swings in the value of these underlying currencies any more than the US is. So, for example, China holds a lot of US treasuries. If the value of the US dollar suddenly collapsed, then China would lose the value of all those treasuries. It doesn't want to do that. It doesn't want to sort of stab itself in the side to win a fight against the US. It's not interested in that. Its strategy is to grow in concert with the US. And that's why it's sort of enmeshing itself even further. And if people might be not comfortable about the sort of degree of economic integration that's implied by the depth to which US treasuries have saturated the world, but I think that's a different problem. And I think more importantly, to go back to the public banking, there are so many layers of the financial system doing things at the moment that it's not worth focusing on that layer. There are other more important things going on. And the foreign policy balance of forces is a problem deeper than monetary reform. It requires an understanding about geopolitics and about military power and about real politics that is deeper than economic reform. I'm not saying that this is entirely separate. I'm just saying that you don't just come up with a good idea and the other side's army goes home. That's not how international relations work.
Exactly.
But with regards to sorry, go for
it. No. The reason why I asked this question is that a lot of the lack of confidence in the United States infrastructure as it stands, and a lot of the concerns about the banks, and a lot of concerns about other things that are going on domestically, there's a lot of true problems, and then there's a lot of not so true problems. And what's happening is there's a lot of conflation. It has nothing to do with logic. If you're trying to address it logically, Rohan, you missed the point. It's got nothing to do with logic. It's got to do with the fact that many, many years ago, people used to draw on cave, walls, these hieroglyphics.
There's xenophobia and there's a sort of fear of the other, and there is this sort of, and this is one of the reasons why a sort of affirmative economic program like MMT provides, it is not nationalistic, but it acknowledges the state as a sort of central, sort of domestic unit of the economy as a central building block of the international system. I think it's important as a counter narrative, but that view that is based in an idea that there's no other hope. And so for what MMT to provide and say, no, there is a sort of growth and there is a growing of the pie that's possible domestically. That's an important thing to look at. And I think if you to go back to public banking, the developing world is having a level of mobile phone connectivity that is simply revolutionary. There's only about 2 billion people left in the world that don't have mobile phone access now, and that's going to go away within another few years. Billions of people have access now to the worldwide internet system through a smartphone, even in very remote areas. And what that has done is changed the landscape for financial transactions, because financial transactions are just sending data in the same way as sending a text message is sending data. The security layers matter. What's in the data matters, but it's still sending a packet of information. So these developing countries have mobile phone-based money systems that are more advanced than banking systems in the West. And this is a very big point because it's cheaper, it's more efficient, but it's run by the telecom companies. It's run by the people who run the mobile phone payment systems, because it started off as sort of mobile phone money. It started off as your text message credits that you would sort of send to other people. You'd send them the balance of your mobile phone account. So there is a merging going on of the telecom and the banking sector. And it's a really important thing to understand in terms of industrial structure, that both of these groups are fighting over the sort of control over information flowing through a transactional network or a network of information packets. And so the mobile phone operators are not interested in being banks, in the sense that they're not interested in making loans and extending credit. They're interested in doing transactions. They're interested in being a narrow bank. So you're seeing places like India and Europe giving a new special form of banking license for narrow banks that do not extend credit when they make loans, but merely move cash around in an instantaneous fashion. When I say cash, I mean their deposits that are backed 100% by reserves.
Explain to the audience what narrow banking is, because this is a term that I'm sure is wonkish in terms of what you're...
Narrow banking means just what I was explaining then. It's like it's like people imagine banking should work, where the only money sloshing around is the money that was put in. So if you put $100 in your account, you send 50 to me, it literally has to take away 50 to give me 50. It's not like the system I was describing before, where the bank is just adding numbers to its own ledger. It doesn't extend loans. It only moves cash around. So this is something like Venmo, right? Now, if you get very technical about it, there is a lag between when you make the payment and when Venmo settles, because Venmo has to contact your bank ultimately. Venmo's moving cash around your bank. It's a layer built on top of the banking system. But basically what happens is, in that transaction lag, something could go wrong. And if something went wrong, it could be that two people have claim to the same underlying money. And if that happens, then you do have the problem that the bank has unintentionally created, so to speak, credit, because there was a lag. So it's relevant to the engineering design of the payment system whether or not transactions clear immediately or whether they take time to clear. And different systems take different amounts of time. Even within the Federal Reserve System, there are different payment systems for different kinds of batches of transactions. Some involve Treasury securities, some involve reserves, some involve other kinds of repurchase arrangements.
So you bring up a great point regarding the narrow banking. You're showing these alternative ways of operating, these parallel institutions, if you will, alternative currencies that are running counter to the state narrative or to the... Yeah. So let's talk for just a minute about the relationship between transactional systems such as Bitcoin or something to that effect as it pertains to... Would a public banking
okay. So the two things that are going on with the payment system is, one is you're sending information. The other, as I said, is the quality of the information. So what Bitcoin and others are is a transmission protocol to send transactions and keep a record of them, but it also limits the quantity of Bitcoins issued. It's also a way of preserving, so to speak, each individual Bitcoin as a store of value. So it matters not only that you have a payments network, but that the sort of individual particles that flow through that is something that has a stable value to it. So blockchain is a payments technology. It's like a database system. It's a secure database system. And as a secure database system, it has interesting implications for data management in a whole range of aspects of the financial system. But as a currency, Bitcoin was basically a digital gold standard. It wasn't very good as a currency. It's good as a speculative investment. If you invest in Bitcoin, you're probably making a lot of money. But it's not good as a transaction system. It's not safe. It's not stable. It's not fast. It's not efficient, because you have to put additional energy into mining each new Bitcoin because it's designed to be artificially scarce. So what you can do, and this goes back into public banking, is create a public payment system. Now, the obvious one is the Federal Reserve System. Banks already have access to a public payment system. They just use reserves to settle between each other. That's just the Fed managing their accounts for them. Now, Ecuador is unique in the world because it gave its own citizens accounts at the central bank, just like the Bank of England used to do. So in Ecuador, individual citizens can manage a bank account run by the central bank through their mobile phone.
Wow.
That is revolutionary. That has the potential to render obsolete a whole range of banking layer institutions. What it doesn't render obsolete is banks as creators of credit and evaluators of underlying loan applications. That is still an important social function. You know, think about some movie where you go to your local bank and you want to set up a new business and they know you in the community and they know you work hard and they give you a loan. You know, that kind of community banking where they do underwriting has real social value independent of the payment system. But because we can do things digitally now that used to require a lot of people spread out along a lot of distance, we can do now with one software system. We don't need to have the payment system divided up into so many different layers the way it is. One major issue that is worth mentioning is that a single central bank account has privacy implications. It matters if one central clearinghouse can see every transaction in the economy. It's important to also have something like digital cash. That is to say, and this is different from a legal perspective, whereas an account entry at the central bank means the central bank has an IOU to you, if you hold a physical instrument or a digital file, that's saying that you have a right over that file. If you lose that cash on the street and someone picks it up, it's theirs. So the ownership transfers with the instrument, whereas with the Ecuadorian system, ownership is attached to your name and your account number. So if you understand the difference, it becomes clear that the eCash system allows for anonymous transactions. You can hold a wallet like you can hold cash. You can barter and trade and pay for things anonymously like you can do with cash. So it's important to have both, in my opinion. To have an account that's public, and I think you should have important safety and privacy protections on that account. But even assuming the NSA gets into that, you should have some form of digital technology that is as secure, anonymous, and private as possible so that the central bank cannot monitor every account in the economy. And if you speak to central bankers, and people I work with have, they agree that they don't want that power. Maybe the NSA would want that power, but central bankers who are responsible for printing currency notes, they don't know where those currency notes circulate. They're not losing sleep that a lot of those currency notes end up in African villages or, end up deep in Europe, or in Southern America. They're fine with that. They don't want to know everything. So there are different interests within the government, and there's some that are more, receptive to concerns about privacy and anonymity than others. But it is important to have digital cash. So with that layer, you could put a postal banking system on top of that. You could have state banks and local banks run their accounts through that system. It'd just be like sharing a database. The other thing that you could do is you could give banks or public banks or state banks or any kind of credit unions the power to create new cash, like a mini mint. And that sounds crazy, but if you understand, as we talked about before, that every time a bank makes a loan, it creates new credit out of thin air that functions as money, it's not changing anything in terms of the supply of money or the liquidity of banknotes. All it's changing is the relationship between the bank and the central bank, and between the bank and its insolvency proceedings if everything goes belly up with its loan. So it matters to change how banks lend in terms of its regulations on its liabilities and its assets, and in terms of its bankruptcy proceedings, and in terms of how it accesses liquidity from the central bank. So, for example, if you were going to say that a bank is essentially a franchisee of the central bank, as Robert Hockett and Sally Omarova from Cornell Law School would say, that say that the job of a private licensed bank as essentially a public-private partnership is to issue bank credit backed by the central bank, which is backed by the full faith and credit of the US government. So this is where people who don't like private banks, again, have a problem. They say, this should be a public function. Why should we let private for-profit banks like Chase make all this money creating private bank deposits that are backed by the full faith and credit of the US government? We're socializing private finance. And they have a point. What the MMTers would say in response, though, is we should absolutely drastically cut down the size of the private banking sector. We should absolutely have public options for payment system and for credit. We should have public banks. We should have economic development programs. We should have zero interest grants and loans. We should just have more public spending. We should obviously have a job guarantee. So we should all have all those things, but they would say in addition to those, it is good to have a small, well-regulated, community bank-based private financial system that issues credit on a profit basis to promote the capital development of the economy. That's not instead of or at the expense of public investment. That is as well as, and that is not their major focus. So they would agree with most of the advocates that trying to cut banking down to size is a good idea. Where they differ, and this is where I agree with them as a lawyer, I'll put my lawyer hat on, is that to try and eliminate the ability of banks to create credit is to effectively eliminate the ability of private entities to create IOUs. And I think as a matter of freedom and a matter of private law and enforcement, it is not feasible to do that. It is not feasible to say, people cannot say, hey, I'll owe you one. It is not feasible to legally prohibit people from running, essentially IOU circles or, things of that nature. And as a result of that, if you ban private banking, on one hand, you will maybe funnel a lot of energy into the public banking system, and I agree that should be funneled as much as possible, but you're going to drive a lot of activity that otherwise would be done on the private banking system into more risky and more fragile and more unstable private credit option. And this is what you saw already with shadow banking. There was an undersupply of safe bank deposits that were insured by the government because bank accounts were capped at $250,000 in the US. I said 150 last time, I was wrong, it was 250. Because of that cap, large money managers that had hundreds of billions or tens of billions of dollars couldn't park their cash in bank accounts. They had to turn to other instruments that they thought were safe as well. So they turned to treasuries, which were safe, but there weren't enough treasuries. There were trillions of dollars of treasuries, but there were even trillions more in demand for safe assets. So they turned to these private financial institutions like money market funds and like corporate debt, issuers and like people issuing a whole range of financial instruments. And they said, these things are as safe as public assets. They said, great, we'll hold them like they're cash. But they weren't cash. They weren't as safe when everything went under. So the issue with trying to prohibit private credit entirely is that it will always reappear in a more unstable and worse version. So my view on that is sort of like with drug prohibition, I guess, legalize and regulate. What you do is, it's like with kids that want to go out drinking, in my opinion. You can say don't do any and then they'll do it behind your back. Or you can say, you can do it under my supervision, but do it with moderation. And you hope that they don't, go crazy. And I think when it comes to private banking, that's the right approach, is that there should be a space for private credit creation, but it shouldn't be the dominant thing, and it should be acknowledged at all points that it is a major lever of monetary growth. There was just recently in April a report by the Bundesbank, the major bank in Germany, the central bank of Germany, that talked about its annual report, that talked about how bank credit creation was the largest driver of broad monetary growth and consumer purchasing power growth. And so it's important when we talk about things like inflation that we acknowledge that in addition to cutting spending and raising taxes, you always have a third option, which is to suppress private credit. There are limits to how much you can effectively suppress private credit, just like there are limits to prohibition, right? So that doesn't mean that it's an absolute lever. Just like there are limits to taxing. You can't tax 100% of everyone's wealth. People would revolt tomorrow, right? So there are always political limits on all of these things. But it is important to note that there is a lever that is affecting private credit. And that's not just in the banking sector. That can also be with shadow banking regulation. That can also be with mobile money regulation. And what the right mix is, I think, remains to be seen. I think everyone is in agreement that it's less now, but I think it is important not to frame the ability of banks to create credit as this unique stealing of a public privilege. What it actually is, and this is the more accurate description, if you imagine the public privilege is sort of up in the clouds, this is a bubbling up from the ground. This is private credit reaching public credit, not the other way around. So you have private entities, before central banks existed, private entities that their IOUs traded as well as bank IOUs, bills of credit of companies and things like this. So the ability of private debt to circulate as money is independent of whether the central bank grants it the full faith and credit backing of the US government. It obviously helps. It obviously helps to have the full faith and credit of the US government. But if you're a large established player in the economy, people are going to accept your debt. You're a stable thing. So when banks have the ability to create deposits out of thin air and create money, it matters that it's backed by the central bank, as I talked about before. But it also matters that a bunch of entities that aren't backed by the central bank created things that look very similar, both mobile money on one hand and shadow banking entities like money market funds on the other. So it's not just about backing by the central bank, it's also about being big enough and important enough in the economy to ultimately know that when power needs to protect the system, it will protect you. And that is independent of whether you're attached to the central bank, because the shadow banks weren't, but they still got bailed out.
Very good. All right, so Rohan, one final thing just to close us out here as we hit up on the hour. We have talked about this in each of the times you've been here, but I think that given the framework of what you've laid out here, once again, Ecuador being a country that actually gave each individual an account, if you will, at the central bank. And previously...
I wanted to talk about the eCash is actually being rolled out right now in Senegal, and it's going to be rolled out in the rest of the West African Monetary Union in the next 2 years. And as a disclosure, I have been consulting with the company that designed the technology for the eCash. And to give you just a little brief description, if you and I wanted to transact, say you had $20 in your wallet and I had $40 in my digital wallet, these wallets, by the way, every dollar in them is created by the central bank as in a special secure way, just like they create physical cash. So it has layers of security with a barcode and everything, but the central bank can't track it once it's out there in the wallet. But what happens is, if you have 20 and I have 20, if I want to send you 10, I basically go to a bank teller window and say, hey, can you swap my $20 for 2 10s and give 1 10 to that other guy standing over there? And they go, yeah, sure. And they take my 20, they give me 10, and then they call you over and they give you the other 10. So you and I never interact with each other, and the bank teller never knows our names. We never have an account at that bank. We just exchange notes. And then you come up and you hand them your 20, and they give you a brand new spanking $30 bill back in your wallet.
Interesting.
So imagine it's a pure MMT idea. It's unprinting money and reprinting money every time you make a transaction.
Absolutely.
Isn't that crazy? And so the way that the central bank, the only thing the central bank needs to know is that the barcodes that are being deleted when the teller rips up my $20 note and rips up your $20 note are equal in the amount to the new barcodes it creates. So it takes two 20s and gives back a 30 and a 10. And that's all the central bank knows. And all it needs to know, just like today, that's the only thing it knows about the amount of paper bills out there circulating, is how many are out there. It knows how many barcodes it issued and which ones it shredded.
That's fantastic. So let me take.
So I just want to let you know those are both real infrastructures that exist in the world today. And as Ellen Brown would say, the Bank of North Dakota is a model of a public bank that provides liquidity and settlement for banks within North Dakota. You could also just have a public postal banking system like they have in the UK or Japan, where people can just have an account at the postal bank, and the postal bank has an account at the central bank. You could also have a mobile money system like they have in the Philippines, where you have mobile money and the mobile money operator has an account at the central bank, or it has an account with a bank and the bank keeps a ring-fenced amount of deposits of an exactly 100% of the amount of mobile money backing it with the central bank. So you can have all these different options, however you want to set it up. But the more important thing, I think, is to ask what kinds of things you want your payment system to do. You want anonymous transactions. You want some form of account that is safe. You want a way for private actors to be able to innovate with consumer-facing platforms that are easy to use and that integrate with their email or their social media. So you want a sort of open protocol that can have apps built on top of it. You want it to be integrated across the wholesale big money markets all the way down to the retail money markets. And you want it to work on mobile phones and on the internet so that everyone in the world can use it.
Fantastic. All right. So with that, Rohan, let me thank you for joining us here at Real Progressives. As always, you're amazing. I can't wait to have you back on. Folks, thank you so much for joining us tonight. We'll be back very, very soon. Tomorrow night, I am departing the MMT world for a night, and I'm talking veganism or whatever the heck it's called. I am not a vegan, so it's going to be interesting. They're going to walk me through this whole process. So with that, thank you, Rohan, for joining up tonight. We'll see you guys soon. Thank you so much, and have a great day, everyone.
Thanks, Steve. Take it easy.
All righty. Bye-bye.